Growing fears that Greece will default on its government debt, rattling global stock and bond markets. Joining us right now to talk about that is Mark Dow. He's portfolio manager of hedge fund Pharo Management and a former economist at the IMF and U.S. Treasury Department. He told BTV back in May that Europeans would build a firewall around Greece and Portugal to limit the possibility of contagion. Well, now he says the cancer is metastasizing at an ever-accelerating rate. I can't get it out, but more importantly, you can. Talked about where we are in terms of the European situation, because at one point, you've talked with Matt and me a lot, you were hopeful. Different feeling now.
Well, no, I was never hopeful that Greece and Portugal could avoid a restructuring. What I was hopeful for was that time was on the European side, and they could build, they could take advantage of that time to build a better firewall around Greece and Portugal, and maybe Ireland,
contagion impact,
so as to minimize the contagion once they did restructure them. However, that all changed. That changed in June, really, and from that point on, when Minister Schäuble started talking openly about a restructuring, it changed the market mindset, and from then on, time became the enemy of Europe, and now they need to move, and they need to move fast.
What about Mark, you mentioned Greece and Portugal, and they're a few percent of the Eurozone. But what about Italy and Spain? I mean, aren't they much bigger, more massivo problems?
Yeah, no, they really are. And that's been the whole game all along has been whether through firewall or through other policy measures to protect the core of Europe, because the peripherals were clearly insolvent and didn't have any possibility of growing as long as they were still fixed to the euro. That's been the view on Portugal and Greece for forever and ever, really. But now, because of the way they've let these things go, Spain and Italy are at risk, and even French spreads have come under a fair amount of pressure. And it's now time to do the unthinkable, which is recognize that the experiment or the European project, such as it stands today, failed. And they have to move like a good trader would from trying to make the investment work to cutting their losses.
Mark, based on what we've seen from European officials over the last year and a half in terms of dealing with this ongoing situation, are we likely to get now a good solution at this point?
It seems unlikely. It seems as though the probability of a disorderly solution is growing. It's good that the IMF is more involved. It's good that China and the U.S. are willing to play supportive roles. But at the end of the day, the Europeans, their first instinct, the first instinct of the policymakers is more Europe is the solution. And I think we're past that point. What they need to do is they need to kick out the peripheral elements that are really dragging down the average, and then reinforce their efforts and reallocate the resources from the peripheral to the core countries to protect them. It's really all about survival now, and they're not willing to take that first step and admit that the project's not working.
So when you say cutting their losses, you mean Italy's out? You mean Spain is out?
No, that's not what I'm saying. So this is how you would do it. Very simple. First, you recognize that it's been a failure, either implicitly or explicitly. Then you recapitalize the banks as best you can, as aggressively as you can, recognizing that it's more about the psychological warfare than it is about the actual level of capitalization. You do that so as to diffuse, short-circuit the propagation mechanism for contagion. It always goes through the banks. Then you haircut Greece and Portugal and probably Ireland aggressively, and take them out of the euro, out of the single currency. Then the ECB has to come out and say they're willing to subjugate their single mandate of inflation fighting to protecting Spain and Italy. They will buy those bonds come hell or high water, and then with that space, try and work on the reforms necessary to get growth into Spain and Italy.
So, but the concern is, right, that, for example, a German high court could rule that a bailout or recapitalization with German money would be unconstitutional, right? I mean,
well, potentially. There are a lot of different ways to recapitalize the banks. I think they have the resources and the degrees of freedom to do that. The more difficult step, really, there's the psychological step of recognizing failure, which is kicking Portugal and Greece out. The other difficult element is to subjugate the central bank, which is essentially the Bundesbank with a disguise on, to subjugating the inflation target to a broader stability target. This the Germans are going to be very reluctant to do, even though it's in their best interest.
Mark, should we hang our hat on the idea that, the FT reporting that a Chinese investment firm might buy, or at least Italy's reaching out to a Chinese investment firm to buy their bonds? I mean, is that just crazy in your view, that that's not a likely scenario and that might not make much of a difference?
China has every incentive to support the status quo. This is true. I think they've been buying euros at strategic points in time to keep stability in the market, because everyone takes their cue from the euro. They've talked about buying things in Greece. They've talked about buying things in Spain, and I'm sure to some degree they're active. So they're supportive. But at the end of the day, you can't save a country from itself. You can't save the euro. You can't save save the EU from itself. They've got to decide internally, take the hard steps necessary to go after the cancer aggressively now, because if they keep trying to patch up the Eurozone and forge tighter integration and think that's going to work, it's going to be much more difficult when the day comes where they have to face up to the fact that it's failed.
Mark, why? I realize that there's a size difference, right, between Greece and Italy, but there are a lot of similarities between the Greeks and Italians. If you're going to throw out the Greeks, why do you keep the Italians? Don't they have a lot of the same issues as far as ability to collect taxes, retirement at an earlier age, corruption issues?
No, I think not. I think the Greeks are in a much worse situation. They're a caricature of the Italians, really. And I hate to say this because I have a lot of Greek friends. But the truth is, the Italians have less debt. They have a better profile for their debt. Before going into this crisis, they had a primary surplus, right? So their budget position was much better. If you look at the Italian debt statistics over the past years, it hasn't been getting much better, but it certainly hasn't been getting worse. That's not true. That's not true of Greece. Italy has a much better competitive position, though it's not good. It's much better than Greece's is or Portugal's is. So they're not really comparable. However, the growth prospects in Italy are very stark. So the Italians need to do something to boost growth, and it's going to be very difficult.
Mark, what about the United States? Is there something we should be doing, some role we should be playing in all of this at this point?
It's very difficult because we're in a fragile state ourselves. But it is true that the Fed is providing swap lines to the extent necessary, support through the IMF for exceptional financing facilities as need be, either to recapitalize the banks or what have you, or just sometimes there's the human capital pushing them along the intellectual path towards recognition of their problem. All these things are helpful, but we don't have any silver bullets to save them either.
The lines of communication definitely have to be open at this point. Mark, we got to run. Thank you, as always. Mark Dow, Portfolio Manager over at Pharo Management.